Boom, baby, $17,800 at market open this morning on a trade. You want all my alerts, make sure you're in that Stocks and Psych group. This definitely helps. I had a little oopsie trade yesterday, so this helps, and I've got more of these coming today, hopefully. Knock on wood as we're trading. Make sure you join to get all the alerts and the course member live streams where I break down all the theses on the plays we're making. I'm highly concerned about what's going on at the Federal Reserve. I believe that the Federal Reserve is starting to realize they're between a rock and a hard place, and it's about to get really nasty for the entire economy. Not only are markets topping out, we've seen that on Bitcoin, the Qs, the S&P 500, the Dow, you name it, Microsoft, it doesn't matter. Not only are we toppy, but we're starting to see some of the catalysts that could really push us over the edge, like slowing growth in the AI world, brought to us by none other than today, ASML coming in with orders at 3.6 billion euros versus the 4.6 expected. That's still a great and large set of orders, but it's flat year over year, and it really hurts the growth equation when all of a sudden you miss by 22%. That's a problem. And so now the question is, what is the Federal Reserve going to do, and where do we sit with the Federal Reserve? Well, first, it's worth remembering that the Federal Reserve has a very important dual mandate. We know about this very well. It's maximum employment, and of course, stable prices. But the Kabisi letter put out a great tweet this morning breaking down where we are starting to see, quite frankly, a breakdown of workforces over the last 4 months. Take a look at this. Tesla, 10% of its workforce. You've got Wayfair, 13%. You've got Hasbro, 20%. Twitch, 35%. PayPal, 9%. eBay, 9%. Citigroup, 20,000 employees. Macy's, 4%. Whatever, blah, 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 blah. So we're seeing these large numbers that are coming through, and so it doesn't surprise us that we're starting to see not only this topping in markets, but also a concern that, maybe the inverted yield curve could be right, and we're starting to see the indication that, you know what, we're about to go into a little bit more of a poopy market. Now, we don't want that. Nobody wants that. But the reality is, the Federal Reserve is about to get squeezed. And here's how the Federal Reserve is going to get squeezed. While we're starting to get some of these leading indicators about pain in the job market, I want you to pay attention to what inflation has been doing and its trajectory for the last 3 to 6 months. Zoom in right here, and you could see the trajectory for the last 12 months. You could see that on a CPI basis, if we look at the last 3 and 6 months and annualize that 3 to 6 month average, inflation's actually trending up to 4.8 to 3.9%. That's substantially higher than what the PCE year-over-year figure is telling us right now. Now, we get the PCE catalyst next week, which is great. We're going to get PCE. We expect it to come in at 2.7, which is the lowest read since March of 2021. So that gives the Federal Reserve a little bit of latitude on, hey, maybe, just maybe, we've got room here and we can go ahead and lower rates at some point this year, especially since we're seeing weakness in jobs. But the PCE forecast uses data from CPI, and the CPI trend from the last 3 to 6 months is very bad. Extrapolating this out, and you have the opposite of what you had last year, where you had this idea that, yay, inflation's finally proving to be transitory. And so this is why I was exceptionally surprised yesterday when Jerome Powell made the following clear to us, and markets actually rallied on it. I thought it was delusional. Yesterday, we had Jerome Powell give us a nice J-Pow to the side of the face. And what did he tell us? Well, of course, he told you that Meet Kevin has an expiring coupon code this Friday for the courses on building your wealth, and that comes with all my buy-sell alerts. This morning, we picked up some $17,000 on an SMCI short. That helps for one of the trades that missed yesterday, one of the trading sets that missed yesterday, and we've got more trades in the books today, a couple more trades that are also profitable, and we're not done trading yet. So if you want all those alerts, make sure you're part of the Stocks and Psychology of Money group. You get every single buy-sell alert that I send. But what are we paying attention to here with JPEL? What's this bizarreness that yesterday we get recent data shows solid growth in the labor market? Well, no, solid growth in labor growth, right? And a lack of further progress. And I should just say in labor, there we go. And a lack of further progress in inflation. This is Jay Powell starting to turn somewhat bearish. He says the labor market remains very strong, And the inflation figures that we've gotten are not giving us greater confidence. This is really bearish and really bad. And I want to show you, I'm sort of going to draw this out so we can see this a little bit more clearly, why Powell is putting us between a rock and a hard place, and it's bearish. I want to be bullish. It's much more fun to be bullish. I've been bullish since the end of 2022, going all the way into this Nike swoosh that we've had, but I think we're about to get introduced to some volatility again. Why is that? Well, think about this. What is Powell saying? He's saying inflation bad and jobs good. That's what he's saying. This would lead us to say that rates are going to be at 5.5, so we'll call it 5.375 as the midpoint, for longer. It really delays our rate cut expectations for the year. In fact, when we look at rate cut expirations or rate cut expectations for the year, right now we're looking at maybe 1.76 cuts, with the first cuts probably not really coming until September. That's when we really price in nearly a full cut by September. So we're looking for that cut in September. And that reiterates this longer aspect. But at the same time, Powell's saying, oh, jobs are so great, we need to focus more on inflation and keep rates higher. What are we starting to see? We're starting to see cracks in labor. And that is a big concern because labor is a lagging indicator, and it can be a really painful indicator because it happens rapidly. For example, yesterday I tweeted the following about Tesla. I said, first of all, I retweeted Sawyer's tweet here where Sawyer said, Tesla has removed nearly all job listings in North America, the Middle East, and Africa. It appears that job listings counts have been reduced by over 80%. This is a problem. And I tweeted this as a problem. I said recent inflation data has not given us more confidence. That's Powell. So we need to fight inflation more. And rates can stay higher for longer, at this level for longer. It doesn't look like we're going to get another hike. But we're starting to see those cuts, like I showed you from Kobisi at the beginning of this video, and at Tesla. See, I think this is becoming more than a Tesla problem. This is actually starting to become an economic problem, where at the same time as Powell says, oh no, we need to get more aggressive on rates, keeping them higher for longer, we're starting to see jobs weakness. That is the worst case possible scenario. Why is that the worst case scenario? Well, because only 15 to 20% of fund managers think we're actually potentially going to go into a recession. Well, usually, right before a recession, everybody gets caught off guard that we're going to go into a recession. And the bond market's been signaling a recession coming for a while. So at the same time as Jerome Powell is starting to pivot back to we need to be more aggressive on inflation, we're starting to see more cracks in the labor market. And I don't think they're just isolated to Tesla. Now, we're at 30 days now. We're past the tax loss harvesting on Tesla. I could buy back into Tesla right now and save $20 per share just by buying back in right now, which would be great. That means for every 8 shares I had, I basically get 1 free. It's buy 8, buy 1 free. Easy buyback right now. But now I'm bearish on the entire economy. And so I don't want to be. I want to just declare victory, right? That would be beautiful right now. I'd like to be able to say, look, I told everybody I was selling Tesla. I told everybody that early in the stocks and psych group like I do. And I said that I would notify everybody as soon as I rebuy Tesla. And so in the meantime, I'm just watching the market bleed. So great. Okay, cool. We made a good move. That's fantastic. Could we have made the move earlier? Of course. Everybody could be more perfect. But the issue right now is these cracks forming in labor, I don't think are only a Tesla issue. And that is making me a little nervous. Now, why is it that we're still getting good jobs data from the Bureau of Labor Statistics? We're not really getting hot unemployment claims. We're not really getting bad jobs data, right? Well, that's because what we're getting is we're getting less job openings. Well, we can track that as a potential leading indicator. So let's do it together. What we're going to do is we're going to look up the St. Louis Fed and we're going to go to the JOLTS. That's the job openings and labor turnover level. And I'm going to specifically go to job openings. And I want to see what happened to job openings as you go into a recession. And then we can overlay some of the other figures as well. So let's go ahead and do this. We're going to do this together. So here we go. Here we can see job openings, total non-farm job openings. You can see job openings slowly decline as you go into a recession, at least comparing back to the 2008 recession. We were already in recession when this figure started falling. We were already in recession when the dot-com bubble started blowing up. And don't even get me started on the Hindenburg indicator this morning. The Hindenburg indicator, which we talked about right here, it was the Hindenburg omen. And it says we have more of an omen right now than we had in 2000 when it comes to the NASDAQ. In other words, a potential red flag leading indicator for a NASDAQ sell-off or sideways trading. That's the Hindenburg omen. You can look that one up yourself. But look at this. Yes, we have job openings plummeting, but they really don't really fall off a cliff until you're really in a recession, right? That's when you really get a fall off the cliff. But now, how does this compare? Let's add a line here. How does this compare to, let's go with non-farm payroll, the jobs report, right? So we're going to go to all employees, add the data series. Okay, now we're going to have to normalize this. So we're going to have to zoom into a period of time where we have both data sets. Let's zoom in right here. And now we need to normalize this. So we're going to go with a percent change from a year ago so we can compare the two. And what happened to my... right. The percent change is very nominal. Wait a second. Hold on a second here. Percent change from a year ago. That's line 2. Percent change from a year ago, line 1. There we go. Okay, cool. So now take a look at this. You actually see the job openings number, with the exception of COVID here. You see the job openings number come down well before you start seeing the all employees level come down. Now that makes intuitive sense. Let's zoom into that. Let's go to 2007. Look at that. So you didn't actually see the non-farm payrolls number go negative until April of 2008. But you were already trending negative on the JOLTS for almost a year before that. About 6 months before that, the JOLTS starts trending negative. And so you can see the JOLTS number is moving down. Those job openings get cut first. So your first leading indicator of an unemployment problem coming is less job openings. And then you get the negative non-farm payrolls report. Let's go ahead and kill JOLTS for a moment, and we can see that more clearly. Look at how long it takes for jobs to really go negative. It really took until May to September of 2008, and then you just fall off a cliff. So looking at jobs, obviously, is a lagging indicator. One of the earliest would be JOLTS. Like, how many job openings do we have? And we start seeing those job openings really collapse and get crushed pretty dang quickly. In recessions, in recessionary times. And again, maybe we're just normalizing right now. That's an idea, right? So let's go put it in. Let's go put jobs again. Let's do JOLTS. Let's look at layoffs. So we already looked at JOLTS. Let's get rid of the other for a moment. Let's get rid of non-farm payrolls. We could look at this together. There, layoffs. When do we get layoffs? Okay, so this is the layoffs read. We really get this layoffs and discharge number not really showing us any fear. Like, this isn't actually that bad. So we're not getting as many layoffs yet. Let's see how that compares to 2008. Jump in over here. Yeah, look at that. Your layoffs and discharge number was, it wasn't really indicative of any massive issue. I mean, yeah, you had these rising levels going into 7 and 8, but I can't really say that the JOLTS layoffs indicator was really a tool for me. Really, what was much more of a leading indicator, again, is job openings. So, you know what? Let's also throw in job openings in construction. Job openings. I think that's one of your recession sensitives. So let's add construction in. Let's get rid of discharge. Yeah, look at that. See, these numbers going negative. That's what you don't want when you look at 2008. Right here. It's the job openings. Those are your first leading indicator. And right now, we're negative on total. Construction's, bobbing up and down. Let's add let's add manufacturing in here, because we've seen a manufacturing rebound. So we'll go openings. And let's do manufacturing, add data series. Here we go. Okay. Yeah, look at that when it comes to recession. So let's try to get 2008 over here. There. All of them go negative first. When all three of them go negative, that's when you're starting to knock on the door of recession. And they stay negative throughout the entire recession. We don't have... Yeah, I mean, you're negative coming out of the dot-com bubble. This JOLT survey started in 2002, so I wish we had more data. And then obviously you're going to be negative in COVID. But you didn't have all of them negative during the 2010s. That makes sense. Of course you had them all negative during COVID. And then you were all negative in 22. We didn't have a recession here. So are we coming out? Are we over that recession? I don't know. But this is what I'm watching. Because if this rotates down again, which I feel like is what we're starting to get as a leading indicator, especially if JPOW is going to, if this is the market pricing in, oh yay, rates are going to come down. We're going to get 7 rate decreases, or, you know, a few rate decreases, 3 or whatever, or 2, just give us something. If that goes away and turns into no rate cuts this year, all 3 of these go negative, this is going to be a powerful, in my opinion, leading indicator of a recession coming. And that's because JPOW gets squeezed into a hard corner. So I'm not happy about that. That's my take right now. That's what I'm watching. The leading indicator is job openings. I've explained why. JPOW is getting pushed into a corner. It's going to lead to more pain in job openings. And you'll start seeing that collapse in openings. So again, going back to what we saw at Tesla. Look, Tesla's got a big pay package that they've got to negotiate in now. The stock never actually went up after Elon's pay got cut, which is really weird because that was anti-dilutive. The stock should have gone up on that and it didn't. So that's odd. It should have gone up. It didn't. The fact is the stock went down. Now you got to price back in the pay package coming back in. That's probably dilutive, right? And so now you're pushing the stock potentially down even more. So that's not good. I'm not saying Elon doesn't deserve his pay package. I think it's messed up that you could kind of undo something that was promised and voted on by shareholders. I get the judge's POV. You've got a judge that's saying, hey, look, you might be wasting corporate resources paying for back work, especially since the majority of shareholders were misled. That's a judge's argument. But let shareholders decide today what they want to do. But, there are arguments on both sides. We'll see what happens. But unfortunately, I don't think these job cuts are just isolated to Tesla. And it's bad news for the broader economy. So we'll see what happens. Anyway, if you want all my trade alerts, make sure you're part of the Stocks and Psych group. We did really well this morning on SMCI. I can throw that up on screen. That's right here. I want to get more of these. So we're going to do some more trading today, and we'll see what happens. And thank you so much. I'll send all my trade alerts. Appreciate you being here, and we'll see you soon in the next one. Thanks again. Goodbye.
Why not advertise these things that you told us here? I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.
Even though I'm a licensed financial advisor, licensed real estate broker, and becoming a stockbroker, this video is not personalized advice for you. It is not tax, legal, or otherwise personalized advice tailored to you. This video provides generalized perspective, information, and commentary. Any third-party content I show shall not be deemed endorsed by me. This video is not and shall never be deemed reasonably sufficient information for the purposes of evaluating a security or investment decision. Any links or promoted products are either paid affiliations or products or services we may benefit from. I also personally operate an actively managed ETF. I may personally hold or otherwise hold long or short positions in various securities, potentially including those mentioned in this video. However, I have no relationship to any issuer other than househack, nor am I presently acting as a market maker. Make sure if you're considering investing in househack to always read the PPM at househack.com.